Good evening, students. Welcome to the session. So today what we are going to start with is a new topic, which was on the taxation of the digital transactions, right? And then, of course, we are going to start with the assessment procedure part as well. So first, we are going to start with the taxation of digital transaction, which is very, very important topic. And later on, we are going to start with the assessment procedures, wherein we'll just quickly touch upon the return of income and all of that. Of course, the income tax authorities topic is what we had to start, but then that I will take it into account when I will start the actual assessment procedure wherein we'll be discussing the assessment part as to how the assessment is carried out. So in that portion only, I will be taking up the income tax authority. So today we'll start with the return of income, PAN, Aadhaar, all of that. Good evening, Salish. Okay, so let's write down the new topic that we are going to start is. I hope the assessment of the charitable trust, you have already revised it properly. So we are going to start with the taxation of digital transactions. Fine. So this is the topic that we are going to cover in detail for the first half at least, and for the remaining time that we will have. And then, of course, whatever time will remain, we will start into that, the assessment procedures part. Okay. So let's get quickly started with the taxation of the digital transaction. I think I made a spelling mistake over here, the taxation. Let me just correct it. Okay. Yes, students. Now, in respect of the taxation of digital transactions, good evening, Viraj, good evening, Shankara. What are the two important aspects that we are going to cover? So the number one is, in the taxation of digital transaction, the number one is the equalization levy and the significant economic presence, which is in relation to the digital transaction. And the second part, which is covered under this particular chapter, is the virtual digital asset. So these are the two parts that we are going to cover into this topic. All right. Now, first of all, understand why we have a separate taxation, or what is the need to have a separate topic altogether as to the digital taxation of the digital transactions. Good evening, Mansha. So this is because of the fact that if you look at the current tax provisions which are there under the Income Tax Act, all right. Now, under the Income Tax Act, the current tax provisions talk about the requirement of the physical presence, because all this while, before the e-commerce was, becoming the latest form of doing the business, or the new form of doing the business, before that, we had the normal regular way of conducting business through the brick and mortar structures. Good evening, Namrata. So, in those kind of businesses, the tax laws were also in accordance with those kind of businesses, wherein the physical requirement was mandated under the tax law. Now, if you look, you would ask, ma'am, which are the provisions you are talking about when you are saying that the physical requirement is mandated in order to have the taxability? I'm not talking about a resident. I'm not at the moment talking about any resident person. Because a residence, any income will be taxable other than the capital receipts, right? All the revenue receipts that you derive from, whether you are doing a physical business, whether you are doing the online sale, whatever it is going to be taxed, isn't it? The problem arises in the case of a non-resident. The problem arises in the case of a non-resident. So in the case of a non-resident, now we are going to little bit towards the international taxation class. Although we have not started, we are going to start in the next month, the international tax class, but we are going to touch upon at the moment certain basics of that in order for you to understand why this taxation of digital transaction is a separate chapter and a separate topic, or a separate taxability has been provided for that. So for a non-resident, Does anybody knows what is the mechanism for income accruing or arising in India? For a non-resident, only the income which is accruing or arising in India is taxable under Section 5 of the Income Tax Act. So Section 5 of the Income Tax Act provides that the income which is accruing or arising or is deemed to accrue or arise in India or is received or deemed to be received in India is taxable in India. Whereas for a resident, global income is taxable wherever arising. For a non-resident, Section 5 provides only the income accruing, arising, deemed to accrue, deemed to arise, or received or deemed to be received in India is taxable in India. That is Section 5 of the Income Tax Act. Now consider there is a non-resident e-commerce business operator. Now he does the online sale of goods or services in India. Versus there is an business operator who is coming to India, setting up a business or a branch in India and doing the sale of goods or services. So let's take two instances to understand the background about this. So instance number one. So if you look at, there is Section 5, which provides that for a non-resident, what is Section 5? Section 5 is the scope of the total income. Section 5 is the scope of the total income. Then what will be my scope of the total income? So for a non-resident, it says income accruing or arising in India will be included in my total income. Income deemed to accrue or arise in India. And the third one is income received or deemed to be received in India. This is my Section 5 of the Income Tax Act. For a non-resident, what is my scope of total income? Income accruing or arising, income deemed to accrue or arise in India, income received or deemed to be received in India. For a resident, so resident here I mean is ROR, not RNOR. For ROR, it is global income wherever arising shall be included in the scope of my total income. I am not touching upon RNOR at the moment. Okay. Now consider the non-resident businessman. Okay. Now in the scenario 1, the sale of goods is through the, let's say, Amazon.uk, not .in, it's through .uk. In scenario 2, the sale of goods are through a branch set up in India. So there is a physical store in India. Okay. Now, we understand what is income accruing or arising in India. Income accruing or arising means that income which is getting generated from India from the source which is lying in India. Now, the source could be anything. There could be underlying contract which has been signed in India. There could be certain transactions which are carried out in India. So that is the meaning of income accruing or arising from a source. But what do we mean by income deemed to accrue or arise in India? For that, you need to look into Section 9 of the Income Tax Act, which provides for the income deemed to accrue or arise in India. Now, when I say income deemed to accrue or arise in India is defined in the Section 9. So, Section 911, 9(1) and then the Roman 1. It provides that for a non-resident, the income would be deemed to accrue or arise in India through or from business connection in India. Now, what do we understand by the term business connection in India? So, income will be deemed to accrue or arise in India through or from the business connection in India. Now, what do we understand by business connection? Business connection means some sort of connection of the non-residents' income that is arising with the activities that are carried out in India. So there has to be some sort of connect between the activities that a non-resident carries out in India and the income that is getting generated from those activities. And it should not be a one-off activity, it should be a continuous transaction. As we understand the meaning of the business is basically a continuous and formal and organized activity that we carry out. Similarly, the business connection also should not be established only from one or the isolated transaction. It has to be a continuous and regular activity which the non-resident is carrying out in India. In India, he's coming and doing some activity in India, and the income that is getting generated therefrom will be said to be deemed to accrue or arise in India. So, meaning, in case if the non-resident is performing certain activities in India, in Indian soil, he is doing some business, then the income which is getting generated therefrom will be said to be deemed to accrue or arise in India. Now, understand there is a difference in two concepts. Doing business with India versus doing business in India. Can anybody tell me the difference in these two concepts? The screen is not visible. स्क्रीन विजिबल है कि नहीं है? जो लिख रही हूँ वो दिखने आ रहा है क्योंकि यहाँ बच्चे कंप्लेन कर रहे हैं. अच्छा ठीक है. Students, are you able to see the screen? Can you please confirm once? Yes, everybody. Whatever I have written for the doing business in India versus doing business with India. Can you please confirm? Are you able to see that? It's not visible? स्टूडेंट्स को विजिबल नहीं है स्क्रीन, वो लोग बोल रहे हैं। हाँ, नहीं, अभी मैंने डूइंग बिजनेस विथ इंडिया वर्सेस डूइंग बिजनेस इन इंडिया लिखा है। नहीं, तो उनको स्क्रीन नहीं दिख रहा है। मैं दूसरी स्क्रीन पर ही लिख रही हूँ जो मेरा शेयर्ड है। एक बार मैं फिर से शेयर करती हूँ, एक बार देख लीजिए। अब अगर मैं लिख रही हूँ तो आ रहा है क्या, देखिए। ये आ रहा है। ओके स्टूडेंट्स, नाउ इज इट विजिबल? Okay, perfect. Yeah. So what I was talking about, students, is that there's a difference between concept of doing business with India versus doing business in India. So can you tell me, do you find any difference between these two adverbs that I have used, with and in? Sure, Shankara, I'll wait for you to copy. But meantime, can you just answer exactly the difference between with and in? Yes, students. Is there any difference or there is no difference per se? Yes, Prerna, that's very correct. Yes, Arun, that is absolutely correct. In India means, Prerna, you're right that it is within the Indian territory. So now I'll give you an example. So let's take an example. This scenario one that we are talking about. This I will put it into the category of doing business with India. So I'm doing the business from outside India without getting into the Indian territory and doing the activities there. Whereas scenario two, I will put it in doing business in India. I'm coming to India, I'm doing the activities, and therefore I'm generating the income therefrom. Now, prior, yes, Mohammed, with India means no need of place of business. You're right. So prior to 2008, when the e-commerce was not on, you know, the e-commerce was not so important, or e-commerce was basically not that particularly doing well. At that time, the physical businesses were happening. So at that point of time, the income tax law, which was framed in 1963, like 61, we have Income Tax Act 1961, right? So the Income Tax Act 1961, when it was drafted at that point of time, until the e-commerce started sinking in our economy, or it became the only way of doing the business now, as we can witness. So till then, this was absolutely fine. That the section 911, which provides that the income accruing or arising from or through the business connection in India will be deemed to accrue or arise in India. Which means what? Section 911, if you look at it, it says that the income from the business connection in India, which denotes that there has to be the connection with the activities that are carried out in India. Now, business connection requires the physical presence. It requires doing business in India. Doing business with India was not regarded to constitute the business connection in any manner. And there have been series of judicial precedents wherein the courts have held that where the business activities were not performed or carried out in India were not regarded to constitute the business connection in India. Meaning, business connection requires to have the physical presence or the physical business activities in India. Are we clear? So basically, what it means is that there has to be some amount of physical activity, some amount of physical presence required when the income has to be said to deem to accrue or arise in India. Are we clear? So that is the basic difference between the doing business in India versus doing business with India, and income tax law which is required, or income tax law the way it is drafted for deeming the income to be accruing or arising in India, right? Now, e-commerce has continued to set in, right? Or e-commerce has become the way of doing the business. And therefore, the question now remains is, whether can one say that the income in the scenario 1 will be deemed to accrue or arise in India? So if you look at it, with the current provision which requires to have the business connection. Business connection, as I said, is not defined under the Income Tax Act, but has been interpreted by the courts in several judicial decisions to mean that there has to be the connection between the activities carried out in India and the income generated therefrom. Now, in the scenario 1, if you just apply the existing tax laws, the income of the non-resident will not be deemed to accrue or arise in India. Because in this case, I am doing business with India. So here, no business connection is constituted. Whereas in this case, I can say I am doing business in India, and therefore the business connection exists. The business connection exists in this case. You can write the meaning of the term business connection to mean connection between activities of the non-resident carried out in India and income generated therefrom. Are we clear? So therefore, if you look at it, now that e-commerce has grown significantly, we would never be able to capture the income into the tax net or into the scope of total income without having amendment in the tax laws. So if no amendments were carried out in the tax law, we would never have been able to capture this kind of income. Because the business connection in no way will get constituted because none of the activities are carried out in India. So in order to capture these kind of transactions, the Income Tax Act has been amended. The Income Tax Act has been amended to provide for two major updates. One is the equalization levy, and the second one is the significant economic presence. Now I'll tell you what is again the background of equalization levy and significant economic presence. You're looking into the act at the moment. But whenever understand a non-resident is coming into picture, the India has signed tax treaties with many countries. And for the income of the non-resident, you need to look into the tax treaty as well to determine whether the country has the right to tax the income at the first place under the tax treaty. If it has the right to tax, how much right to tax it has. So under the double tax avoidance agreement, the source country, you need to decide whether it has the right to tax. What are the double tax avoidance agreement? Double tax avoidance agreement are basically the agreements which are signed between or which are entered into by the two sovereign nations to avoid the double taxation on the same income in two different countries. Are we clear? Why? Because he is a non-resident. So he will be taxed in India on the income accruing or arising or deemed to accrue or arise in India. At the same time, he is a resident of some other country, so he will also be taxed in his resident country. So on the same income, he will be taxed twice. Once in India and second time in his resident country. So in order to avoid double taxation, the double tax avoidance agreements are entered by India with several nations. So wherein India will agree with the other country, and so the other country will also agree with India that whenever the income is getting taxed twice, we agree to avoid the double tax by restricting the right of the source jurisdiction, wherever the source of income is, to tax that particular income in a limited way. So for the business income, how the income double tax is avoided. For the business income, how the double tax is avoided. For the business income, the tax treaties say that the business income can only be taxed in a particular jurisdiction where the income is arising. Only when there is business income can be taxed in source country only when there is permanent establishment in the source country. Only when there is a permanent establishment in the source country. Unless there is a permanent establishment in the source country, the business income cannot be taxed by source country. Now, what do we understand by permanent establishment? The permanent establishment is similar to the term business connection. Permanent establishment in simple meaning means fixed place of business. In simple language, it means a fixed place of business through which the non-resident carries out the business. Now, under the Act, you have the business connection. So you will say that yes, I have the business connection in India because there is a branch, there are activities being carried out in India. So therefore, there is a business connection. Under the treaty also, you need to see whether the PE is getting constituted. So if there is a fixed place of business in India, then even the DTAA will give the right to India to tax that income. So if the PE is not constituted, then India cannot tax the income. Now, PE is a much narrower term and a much defined term than a business connection. Business connection is not defined under Income Tax Act, but PE is defined under tax treaty. It's a very, very narrow and very well-defined term. So it is possible that there may be business connection, but no PE. Now, the point here is that again, if you look into the taxing rights under the DTAA, a source country will get the taxing right only when there's a PE. PE again requires a physical presence, a physical form of doing business. Again, here under DTAA, online business models are not covered. So online business models will never have a fixed place of business in the source country, and therefore there will never be a taxing right to the source jurisdiction even under DTAA. Now, having said that, the countries all across the globe are grappling with the e-commerce transactions, how to tax them. And therefore, the OECD, Organization of Economic Commerce and Development. So OECD is a country, OECD is a group of, or OECD is a body which kind of sets the policies for the international tax laws, Organization for Economic Cooperation and Development. It's an intergovernmental organization. So this particular organization, it's a global body that kind of sets out the, or not sets out, I would say that kind of provides the framework as to how the tax laws should be there. For the international tax laws, how the DTAAs should be understood, how the DTAAs are to be interpreted, how the DTAAs are to be negotiated. So they basically work on establishing certain international standards and finding the interpretation mechanism for the DTAAs. Now, OECD was reached out by several countries, by the G20 nations, to provide some sort of solution for taxing the digital transactions. So it's basically a forum where the member countries come together to kind of interpret the international tax laws, to provide solution, to provide kind of help to all the countries in terms of interpreting the international tax laws. Now, G20 member countries, including India. So India is a part of G20 member country. Now we have the presidency also of the G20, right? So G20 member countries reached out to OECD to give some solution to tax the digital transactions. Otherwise, it was resulting in tax avoidance. Are we clear? So therefore, OECD came up with the BEPS action plan. BEPS is Base Erosion and Profit Shifting Action Plan 1. Because it was resulting in tax avoidance, so this base erosion and profit shifting action plan 1 was developed by the OECD in order to provide some sort of solution for taxing the digital transactions. So in this BEPS Action Plan 1, OECD recognized that yes, these kind of online business models are kind of posing the challenges on the existing tax laws, because the existing tax laws require the physical presence in order to have the income taxable in a particular jurisdiction. So in case of a non-resident, the income can only be taxed when there is some sort of business connection or there is a permanent establishment getting constituted, which is not possible to have in the case of the e-commerce or digital transactions. Because now that you see, we have digital wallets, Paytm, Google Pay, right? We have online grocery stores, Blinkit, Zomato, Swiggy. We have the online banking system at the moment, which are fintech platforms. You have PayPal, you have Wise, you have so many other fintech platforms to receive the payments. You have Paytm Business. You have now Amazon, Flipkart, eBay, right? So there are several things which are now possible to do without any physical presence. So these kind of business models are challenging the existing tax laws. And secondly, it is difficult to even characterize the income, because the current tax laws have only the income, let's say income from business, income from house property, income from salary, capital gain, income from other sources. But in these kind of payments, there is difficulty in characterizing the income. Whether this is royalties, whether it is fees for technical service, whether it is a business income, it's very, very difficult. It is difficult to locate the transaction. See, it is possible that let's say there is a non-resident seller who is selling the goods. So he's a seller, let's say from US. He's selling the goods on Amazon UK. Amazon UK has the website and the server, let's say in Ireland. So where the transaction is being carried out, there is difficulty of locating the transaction, the activity, and identifying the taxpayer. So therefore, the OECD under BEPS Action Plan 1 recommended 3 options to the countries in order to tax the digital transactions. Number 1, introduce the significant economic presence. Number 2, equalization levy. And number 3 is withholding tax. Withholding tax means the TDS. TDS on the digital transactions. And India has adopted all these 3 options under the tax statute. So you have significant economic presence, you have the withholding tax under 194O if you have done that already, and an equalization levy. But these were the interim solutions which were proposed by the OECD, because OECD at that point of time in 2015 when the BEPS Action Plan was released, OECD said we are still in the process of coming to a final conclusion as to how we should tackle the challenges posed by the digitalization of economy. This is not a final solution. This is an interim solution that we are providing. We still need to work on, research on as to what should be the final solution to tackle this problem. And even today, the OECD is still struggling to come up with a final solution. But these were the interim solutions which India has adopted into its tax laws. So is the background very, very clear? No, the permanent establishment Mansha is not similar to POEM. We will do that in the international tax class. What is POEM? And you would understand the difference between the two. So POEM is basically to determine the residence of a company. Permanent establishment is to tax the business income. It's similar to the business connection, not POEM. Shankara, it should be available. In case it's not available, you can ask them to email you the notes. Okay? So, is the background clear, students? Yes or no? Are we clear? Any questions so far? What is the background of introducing the equalization levy? Yes, and the significant economic presence. So first we are going to talk about the significant economic presence. Okay, first we are going to touch upon that. And then we will of course talk about the equalization levy as well. Now, in terms of the significant economic presence, as I said, the existing business connection definition which is there, that is framed to have the requirement of the activities being carried out in the source jurisdiction. Isn't it? So the activities should be carried out in the source jurisdiction in order for the taxability to be there. So therefore, the business connection was amended to include even the significant economic presence. So section 911 was amended to introduce the concept of significant economic presence. Now, what is significant economic presence? Let's try and understand that. As I said, the business connection requires to have the activities being carried out. So, explanation 2A has been introduced in section 911. This has been introduced to section 911 to provide that significant economic presence, SEP, of a non-resident SCP of a non-resident shall constitute the business connection. So SCP of a non-resident shall constitute the business connection in India. SCP of a non-resident shall constitute the business connection. So SCP means that even though I'm not doing business in India, I'm doing business with India, still it would result in the business connection because there is a significant economic presence, though not physical presence. So I'm interacting with a jurisdiction in such a significant way that my economic participation is existing even though I'm not physically present. Now you would ask, ma'am, how do we ascertain that what is significant economic presence or when the significant economic presence is getting constituted? So it says that the SCP shall mean SCP means two things. Transaction in respect of goods, services, or property carried out by non-resident with any person in India. So transaction in respect of goods, transaction in respect of and not transaction of goods. So it not only includes sale, purchase, but it also includes any transaction in respect of goods, services or property, which means it will include the transportation, the advertisement, any kind of transaction. Even the payment transaction, payment facilitation, commission, whatever. So transaction in respect of goods and not the transaction of goods. If the words used were transaction of goods, meaning it would have only included sale and purchase. It says transaction in respect of goods, services or property carried out by a non-resident with any person in India. With any person in India, including the provision of download of data. Including the provision of the download of data or software. So, any transaction which has been carried out by a non-resident, that will be constituting the significant economic presence. Now, there are the thresholds which are given. So, the thresholds are given in terms of that only when this threshold has been met, only then the significant economic presence will get constituted. So what is the threshold which they have given? So the thresholds that they have given is 2 crore rupees. So this transaction, if it exceeds rupees 2 crore. So if it exceeds rupees 2 crore, then only the SCP will get constituted. Second transaction where the SCP can get constituted is systematic and continuous soliciting of business activities. Systematic and continuous soliciting of business activities or engaging with users in India. Engaging with users in India. Now, how many users they have prescribed here? Greater than 3 lakh. So, if there is any kind of continuous engagement with the users through the advertisement, through let's say Instagram, where they are collecting the data, through Facebook, through WhatsApp, all of that, if it's more than 3 lakh user base, that will constitute the income arising from that activity will constitute the SEP in India. Now, this is irrespective of the fact that whether any kind of agreement has been entered into India, whether the non-resident has a place of business in India, or whether the non-resident comes and renders the services here in India. Irrespective of that, the income from the SCP will be deemed to be accruing or arising in India. Are we clear? Yes or no? So is SCP clear? We will again be discussing the SCP when we will go to the international tax class. Namrata, as I said, the SCP here means that I am not engaging physically here in the source country. I am not doing any physical activities, but despite remaining outside India, I'm interacting in a significantly economic manner that my economic activities, even though remaining outside India, are significant and for which the thresholds are prescribed. Then the SEP will get constituted. Yes, Arun, it's more or less like the OIDER services under the GST law. You're correct. Arun, it's not necessarily the principal and agent service because here it could include the advertisement, commission, e-wallets or your fintech platforms. Everything gets included over here. Okay. Yes or no? Any questions? Any doubt? Okay. Now, this is about the SCP. That is the amendment under the Income Tax Act under Section 911. Now, simultaneously, the implication of this amendment is that this amendment has been carried out in the income tax law. The corresponding amendment has not been carried out in DTAA because, as I said, a source country can get the taxing right only when the DTAA provides for that. And for business income, the DTAA says that the source country will get the right to tax only when there is a permanent establishment in the source country. Now, it is possible that the SCP will get constituted. But when you go to DTAA, the P definition has not been amended. Under the DTAA, the rule still remains that of P. As I said, the OECD is still coming up with a solution as to what should finally be done by all the countries globally. As of now, there is no concrete solution which is in place. So the DTAAs remain unamended. So even though the amendment has been made under the Income Tax Act, when you go to DTAA, the DTAA will not allow you to tax that income because DTAA still has the concept of P. And as per Section 90 of the Income Tax Act, the provisions of the Act or the DTAA, whichever is beneficial, will be applicable. Since the provisions under the DTAA will be more beneficial to a non-resident assessee because his income will not be taxed in source country if he does not have a P. So that will remain applicable despite having the amendment in the income tax law. We cannot tax the income where the non-resident is coming through a country with which India has a DTAA. Are we clear? Yes or no? So therefore, we have also introduced the concept of equalization levy, which is not coming as an amendment through the Income Tax Act, but which is coming through the Finance Act 2016. A separate chapter has been introduced in the Finance Act 2016 of the equalization levy. So as to keep it outside the purview of DTAA, because DTAA only regulates the Income Tax Act. Only the income tax is going to be subject to the DTL. So therefore, deliberately, they did not amend the Income Tax Act to introduce equalization levy. They introduced equalization levy through the Finance Act, just like we have the security transaction tax, the commodity transaction tax, which are operating as a separate levies. Similarly, we have the equalization levy in place. So DTAA will not override the equalization levy. Yes, Namrata, DTAA will override the income tax law, but will not override the equalization levy. And that's why we have the equalization levy in place. So what is equalization levy? We have two equalization levy. EQL 1.0 and EQL 2.0. Both are very different. One was introduced in 2016 and the second one has been introduced in 2020. Now, what are these 1 and 2 types of equalization levy? First, we'll talk about the equalization levy 1.0. So after BEPS Action Plan 2015, when the OECD recommended equalization levy as an interim measure, immediately in the budget of 2016, India introduced the equalization levy 1.0. Now this equalization levy 1.0 is at the rate of 6%. This equalization levy is at the rate of 6%. And this one is at the rate of 2%. First, I am giving you the differences between the two. So this is at the rate of 6%, this is at the rate of 2%. This equalization levy, this operates like TDS, meaning the obligation to deduct equalization levy is on the payer. Whereas this equalization levy 2.0 operates like self-assessment tax, meaning the obligation is on the non-resident e-commerce operator or the taxpayer himself, right? So these are the major differences. This is on the digital advertisement, whereas this one is on the e-commerce operations. Okay. So these are the differences between equalization levy 1 and equalization levy 2. Now first we'll talk about equalization levy 1. So there is a non-resident service provider. There's a non-resident service provider, right? Who is providing the services to the service receiver. So first we'll write it here. Service receiver. Now what kind of services he is providing to the service receiver? So he is providing 3 services that we are going to write it over here. So write down services in the form of online advertisement. Online advertisement. Secondly, Secondly, the online sale of space, digital space for the advertisement. Okay. So this is on the online advertisement, number one. Secondly, this is on the digital space, which is being provided to a non-resident. So first is online advertisement. Second is any provision for the digital advertising space. Fine. These are the two services which are getting provided by a non-resident service provider to the service recipient. Now, for the applicability of this equalization levy, for the applicability of equalization levy 1.0, this is provided under section 165. This is provided under section 165 of the Finance Act and not the Income Tax Act. So, specified service, you can write it over here, not just services, but you can write the specified services. Specified services if it is providing by a non-resident, which is provided to a person resident in India. Who is the service receiver? A resident of India. Secondly, a non-resident having P in India. Service provider has to be a non-resident. Service recipient is going to be a resident, or it is going to be a non-resident having the PE in India. So one non-resident providing services to another non-resident having a PE in India, that will also be subject to equalization levy. Now this resident of India carrying on business or profession. So what is excluded is personal services. So if I am obtaining the services for my personal use that are outside the scope of equalization levy. So a resident in India should be carrying out the business or profession. The services should be for the business or profession. And if when other here also there is exclusion, if the non-resident service provider has a PE in India and services are effectively connected to the PE. So if the non-resident service provider has a PE in India, equalization levy will not be applicable. Why? Because if a non-resident service provider has a PE in India, then automatically you will go to section 9. You will also have the business connection. When you're falling under the Income Tax Act itself, then why do you come to equalization levy? Are you getting that point? The entire problem is arising because the person who is carrying out the business does not have a PE, does not have a physical presence, and that's why we brought in the concept of SCP and the equalization levy. But once you say that I have a PE in India, the service provider, you go to section 9. You are excluded from equalization levy. The service recipient can have a PE in India. A non-resident service recipient can have a PE in India. But the service provider, if he has a PE in India, then you are already covered under section 9, business connection. Then there's no question of coming to equalization levy, because equalization levy is for a non-resident service provider in the first place. Are we getting that point? Yes or no? So this is for a non-resident service provider who is providing the specified service of online ad or provision for digital advertisement space, and a service recipient who is a resident of India carrying on the business or profession, or a non-resident having a P in India. So basically the personal services are excluded. So let me give you a live example of that. Google Ads. Who is going to be covered under here? Google Ads, Facebook Ads. So when you go to, let's say, Google, do you see on any website that there are certain ads which are appearing on the left hand side, right hand side, isn't it? When you open any website, you see that there are certain ads which appear as the top banners, isn't it? So what are those? So the advertisers are basically paying to the Google or to those websites that you please display our ads to the person who is viewing your website. So let's say I was searching for shoes in Bombay. Sports shoes I wanted to buy. So sports shoe shops near Bombay. And once I open up any website, then there will be the same shoes which will be appearing on the left side of the top banner which is there. Isn't it? So what is that? Those are the advertisements which are paid by the or purchased by the online ad space, which is purchased by the company which is selling the shoes. Isn't it? So that kind of payments by the company who is selling the shoes to Google or to that website will be covered under equalization levy 1.0. Will be covered under that. Are we getting that? Or let's say, for example, you go to Google. Let's take a live example. Let me just open up Google for you. Okay. So if you look at, let's say we go to google.com and I write it over here. Best sports shoes. If you look at here, these are all the ads which are coming over here. Isn't it? Or let's say, for example, if I go here and write best hotel stay in Mumbai. So here, if you look at, these are the ads which are coming over here. Booking.com, make my trip. Are we getting that particular point? So if you look at these kind of advertisements are being paid for. These are the advertisements which are being paid for. And this results in the equalization levy 1.0. So you sometimes, search for certain things and you find that this is sponsored ad. There are sponsored ads which come up on the top. Isn't it? That is basically the Google ad program, or any other search engine will run that program. And that kind of leads to the equalization levy 1. So now whatever search results I'm getting over here, let's say I'm searching for best hotel over here. And these are the top results that are coming up because they have paid to Google to display this. Or let's say I write it over here. So I'm just searching for the words that come up as a sponsored over here. Now, this particular company would have paid to Google and it will have to deduct the equalization levy. Now, even though this telegraph is the non-resident, but if it has a P in India, still equalization levy 1.0 will become applicable. Are we clear? Yes or no? Now, what is the equalization levy which is applicable over here? It is at the rate of or equalization levy at the rate of 6%. And again, one more important thing over here. Here, the threshold which is provided for the services which are there, the threshold which is provided is over rupees 1 lakh. So only when the threshold. Oh, sorry. Yeah. So what I was saying, student, is that only when the threshold is crossed, then only you will have the equalization levy being applicable. Now, equalization levy, as I said, will also be applicable on the, so the obligation will be on the payment being made by the service recipient. So the service recipient needs to deduct the equalization levy at the rate of 6%. Yes or no, students? Any question? Any doubt? Yes, is this clear? Okay, let me show you one more example. Let's say, for example, I'm searching for my dresses. So if you look at here, see, I searched for N dress. This is a brand through which, let's say, for example, I want to purchase the dress. I search for N dress. If you look at it, here it shows sponsored, meaning and India is paying to Google the advert for the ad space, for the advertisement, for the online advertisement. So and India is required to deduct equalization levy at the rate of 6% because Google is a non-resident company. Let's say, for example, now Google gives you the option. Let's say Google gives you the option that if you want, you can make the payment to Google India and not Google Ireland. So Google is usually, it asks for the payment to either Singapore entity or Ireland entity or the Indian entity. Let's say, for example, if I'm making the payment to the Indian entity, will the equalization levy be applicable? So let me here give you the example. So let's say, and India making the online advertisement payment to Google Singapore or Google India. Will it make any difference? So on this, equalization levy at the rate of 6% will be applicable. But what about Google India? On that also, there is equalization levy will be applicable. Yes. When I make the payment to Google India, will equalization levy be applicable? Yes, students. Faster. Yes, students, faster, please. Yes, students, I'm not getting any answer. Will the equalization be applicable on the Google India payment being made to Google India? Will not be applicable, students. Why it will not be applicable? Yes, Namrata, you are correct. Yes, Mohammed. Because this is provided by the Indian resident. Google India will be an Indian entity. It will not be a non-resident entity. So in that case, it will not be applicable. Or let's say, for example, if Google Singapore has a P in India, then also it will not be applicable. Okay? Yes, Namrata, very good. So here, no equalization levy. Here, equalization levy will not be applicable. But there is one more thing which can be applicable over here. What? The TDS. TDS can still apply over here. So on the online advertisement, TDS under section 194C can apply if it is a contract which I have made with the Google India. Okay. So TDS can still apply over here. Fine. Yes or no? Okay, students. Yes or no? Any questions? Any doubt? Fine. Okay. So shall we take a small break of 10 minutes and then we start with the equalization levy 2.0? Let's take a break of 10 minutes. let's start with equalization levy 2.0 then. This is under section 165A of Finance Act 2016. So similarly, this is 165 of Finance Act 2016. Okay. Now, what is equalization levy 2.0? What does it try to do? As I said, the equalization levy 1.0, which was there, that was only limited to the online sale of goods or service, online advertisement, right? But this one, which is there, this is on the online sale of goods. This is not on the online advertisement. So wherever equalization levy 1 is applicable, there we have the online, there we have the equalization levy 1, and here we have the equalization levy 2 when the e-commerce operator is there. Okay. So as I said, that if you look at now equalization levy 1, whenever there is online advertisement, sale of digital ad space, we saw that. What is sale of digital ad space? What is the online advertisement? Also, one more example I can give you is when you go to the Instagram, when you log into your Instagram account, right? On that also, there are certain sponsored reels which come to your reel section that you're watching, right? Which is similar to the reels that you're watching. Those are the sponsored reels. Again, that is the online advertisement. That will be covered under equalization levy 1. Okay. Now for the equalization levy 2, which is there. For the equalization levy 2, which is there, that is something now we are going to discuss. Okay. So just write down. Equalization levy 2.0. This is under section 165A of the Finance Act 2016. Now, to whom this equalization levy 2.0 is applicable? So, this is on the, what does section 165A says? Let's read out. Section 165A says that equalization levy at the rate of 2%. Equalization levy at the rate of 2% shall be charged on the consideration which is received or receivable by an on the consideration received or receivable by an e-commerce operator from the e-commerce supply or services from the e-commerce supply or services which are made or provided or facilitated by it, which are made or provided or facilitated by it to the service, or let's not write the service recipient, to three situations: person, resident in India, second, non-resident, leave some space, and then write person who buys goods or services person who buys goods or services using IP address located in India. Using the IP address located in India. Fine. So this is going to be applicable to e-commerce operator, which is providing, making or facilitating the e-commerce supply of goods or services. The e-commerce supply of goods or services to a person resident in India, to a non-resident, to a person who buys goods or services using the IP address located in India. Now let us try and understand each of these situations and each of these words. Okay, each of these situations and each of these words we will try to understand. So now first is, it is saying the consideration received or receivable by an e-commerce operator. Now who is an e-commerce operator? Section 164 of Finance Act defines all of these terms. So who is an e-commerce operator? So e-commerce operator means a person who owns a non-resident, who owns, operates or manages digital or electronic facility. Manages digital or electronic facility or platform for online sale of goods or online provision of services. So the e-commerce operator has to be a non-resident. The e-commerce operator has to be a non-resident who either owns the website or electronic facility or digital facility, who operates the facility or who manages the facility for the online sale of goods or online provision of services. Now, if you look at it, if I'm owning a website through which I am either making the sale of goods or services or providing some services through that website. Let's say, for example, I have a website, let's say this and dresses. I will give you the examples. You tell me whether it will fall within the definition of the e-commerce operator or not. Let me share you the screen. Okay, so you will tell me whether this is going to be the e-commerce operator or not. Okay, so let's say, for example, I take the Nike shoes. So whether this is e-commerce operator or not, this is the website. Whether this is e-commerce operator, yes, students. Is this falling under the definition of e-commerce operator? Yes, students, faster. Yes, it's an e-commerce operator. Why is it e-commerce operator? Because this Nike is, let's say, a non-resident. Okay, we do not know this is a resident entity. It's .com. It's not .in. So this is the E-commerce, non-resident e-commerce operator who is owning the digital or electronic facility or platform for online sale of goods. I can buy the goods through this. So this is making the sale of the goods. So therefore, um, this is the e-commerce operator, right? This is the e-commerce operator. Let's take another example. Let's say I'm trying to book. Let's say I'm trying to book in Taj Maldives. Okay. So whether this is the e-commerce operator or not. Yes. What do you think? Whether this is e-commerce operator? Yes, students. Yes, Namrata, this is a resident. So therefore, this will not fall within the definition of the e-commerce operator. You're correct. Let's take another website. Let's say, for example, I'm going to booking.com. Let's say this is booking.com. Now I'm putting up here. Let's say I want to travel to Germany. Let's say I'm going to Berlin day after. Okay. For 2 days. So whether this is e-commerce operator or not. Whether this is e-commerce operator or not. Yes, students. This is e-commerce operator. Yes, it is a non-resident. But then why is it an e-commerce operator? Yes. Why is it an e-commerce operator? This is an e-commerce operator because it is facilitating the online provision of services. So therefore, this is an e-commerce operator, right? So here, this will be covered as the e-commerce operator. Let's take another example. I'm trying to book Hilton, Germany. Let's say there is Hilton Hotels in Germany. This is a non-resident company. Again, this will be, I'm directly trying to book through this website. So this is the online provision of services through the facility or through the website which is operated by Hilton. So again, this will be the e-commerce operator. Now, in all of these situations, if you look at, I told you that this particular equalization levy would be applicable only when the e-commerce operator provides or facilitates e-commerce supply or services to a person resident in India. So if I am booking through this particular website, through Nike, through booking.com, through Hilton, then this will be covered under equalization levy. So I don't have to deduct the equalization levy unlike in the case of 1.0, where the payer had to deduct. Here, the e-commerce operator himself has to pay 2% on the consideration received or receivable. Are we clear? Then the second situation is, we'll keep the non-resident aside. B point, we'll keep it aside. We'll touch upon the C point. It says, person who buys goods or services using the IP address located in India. So, let's say, for example, if I am not a person resident in India, I am a non-resident. but I buy the goods or services using the IP address located in India. Now, what is an IP address? So IP address is a unique address, like you have your own address where you are staying, isn't it? So IP address is like a unique address that identifies a device on the internet. Are we getting that? So IP address, if you look at when you're filing the return of income also, that time, if you look at the acknowledgement, it captures your IP address. So that is a unique address which is there, which is basically for the particular device which is operating in the internet. It's a unique number, identifying number, which is assigned to every device which is connected to the internet. Right now also, if you go and search anything on Google, you will find your IP address at the end. Isn't it? You will find your IP address which is given to you. So this is basically a unique address which is operating. So now, if I am connected to, I'm basically accessing the IP address located in India. So I'm accessing any website, any digital facility if I'm not a resident person, but I'm buying the goods or services using the IP address located in India. Then in that particular case, there will be the equalization levy which will be applicable. Yes. So IP address is basically to identify the network or identifying the location of a device. It is not any random number. It is a unique number that is assigned to every device on the internet. So if I'm using the IP address located in India, then in that particular case also the equalization levy will be applicable. Yes, foreign tourist comes in India, buy the goods from the IP address in India. Yes, the equalization levy will be applicable, Namrata. Yes, very well. It will be covering the equalization. It will be covered under equalization levy in India. Okay, because your IP address will be location specific. You know, when we go to Europe, you're not able to access certain websites. For example, like Hotstar, Disney Hotstar. You're not able to operate there because it does not comply with the privacy norms there. So there are these virtual IP addresses which are available, or VPN networks which are available, which you can, basically use it. Okay. So again, if you're using the IP address located in India, so then in that particular case, the equalization levy will be applicable. Now the third situation is in the case of a non-resident. In the case of a non-resident, the equalization levy will be applicable only in the specified circumstances. So you can just write down over here, in the case of a non-resident, in specified circumstances. Now, what are the specified circumstances? Let's try and understand. So, in the case of the non-resident, the equalization levy, one non-resident paying to another non-resident we are talking about. Equalization levy will be applicable only when in specified circumstances, which is sale of advertisement which targets a customer who is resident in India or who accesses the advertisement through IP address located in India. Secondly, sale of data collected from person resident in India or who accesses the IP in India. Fine. So these are the three situations in which equalization levy will be applicable. Equalization levy 2.0. First one was a non-resident e-commerce operator providing or facilitating e-commerce supply or services to a person resident in India. Second is a non-resident in specified circumstances. So one non-resident e-commerce operator providing services to another non-resident. What services? Sale of advertisement, which targets the customer who is resident in India or accesses the advertisement through IP address located in India. What do we understand by that? Let's say, for example, Nike is, let's say, a US resident. Now, Google is selling the advertisement space to Nike. Now, the Nike's ads are going to be directed only to the Indian resident or any person who accesses the advertisement through the IP address located in India. Then in that case, Google has to pay equalization levy 2.0. Now you will say, ma'am, even in the case, equalization levy 1.0 is also applicable because there is sale of advertisement. You are right. There is sale of advertisement. Equalization levy 1.0, if you look at, is applicable in the case where a non-resident provides the services of online ad space to another non-resident. But in that situation, the service recipient, who is a non-resident, should have a PE in India. In case of applicability of equalization levy 1.0, the non-resident who is service recipient should have a PE in India. If he doesn't have PE in India, equalization levy 1.0 is not applicable. But in that case, equalization levy 2.0 can still apply. Then you will ask, ma'am, what if there is 1.0, 2.0 both applicable in the situation where non-resident having a PE in India is purchasing the advertisement space from Google? So whether we will apply 1.0 or 2.0. The Act says where equalization levy 1 is applicable, equalization levy 2 will not apply. So you can write down over here where EQL 1.0 is applicable, EQL 2.0 will not apply. Okay. So 2.0 will apply where 1.0 is not applicable. Second is, it will also apply to a non-resident e-commerce operator selling the data collected from a person resident in India or who accesses the IP address located in India. Now, you will think that, ma'am, Google is free, Instagram is free, we are watching reels all the day long, and it is free. But students, nothing comes for free. You may think WhatsApp is free. These days, WhatsApp is spamming more than, even the telemarketing agents these days. Don't you get a lot of ads on even WhatsApp? How are you getting those ads? So if you see on Instagram, on WhatsApp, what happens is these websites collect your data. Which bank you are transacting with, that bank will kind of send you updates on WhatsApp that we are offering this credit card, we are offering this loan, please take it. Or let's say, for example, I buy from Mintra, then Mintra will start sending me update. There is a sale, there is an online sale which is happening. Or you get or go on Instagram, right? You're scrolling on Instagram, but you think Instagram is for free. I'm saying Instagram is not at all for free. You are selling your data to Instagram, which Instagram sells to the online advertisers. By collecting your data, they analyze that data and then they target that advertisement selectively to you. You see the sponsored ads on Instagram? Yes, you see the sponsored ads. Those ads are nothing but the Instagram's income, Namrata. Instagram is charging money for those ads. So when you make a reel, if you ever try to make a reel, just try and make a reel, okay, and then you may delete it also. There will be an option of boost ads on Instagram. So then when you try to boost that on Instagram, they will give you an option of what is your budget that you want to set in to target and what is the target audience that you're looking at. So whenever you try to make any reel on Instagram, it will give you this particular option. Boost a reel. So when you do a boost a reel function, when you opt for that, it will say that what you want to do. Do you want the audience to visit to your profile so that they make aware about your brand, so that they try to follow you, your followers increase, or you want to direct them to your website, or do you want them to message you? So when you see the sponsored ads, these are the three options that appears. Visit the profile of that particular page, visit their website to buy that good, or to message them. Let's say, for example, if I select visit my profile, then it will ask me what is the audience that you want, which audience your reel should reach out to. You may just create your own audience based on the location, based on the age, based on the gender, based on the interest. And then Instagram will tell you this is my ad cost. Are we getting that? Yes, Namrata, similar is the case even in YouTube. When you search any product on Amazon, your data gets collected by your phone, which is passed on to YouTube, or which YouTube basically collects that data. So YouTube has access to your contacts, to your camera, to your microphone. You are allowing that access. So that's why I said nothing comes for free. So YouTube collects that data and gives it to the advertisers, and that advertiser will then target towards you. So that's why when sometimes it also happens that we may just say a word, okay, today I'm saying a lot of times that I want to, buy Nike shoes. I want to search for hotels in Germany. Sometime later, I would not even today I've searched on Google, but sometime later I sometimes not even search that product, and I'm just verbally communicating with somebody, and suddenly Instagram will display the ad of that shoe, or YouTube will display the ad of that shoe. How come? Because your phone is allowed, or you are allowing the access to your microphone also to Instagram, YouTube, and WhatsApp. So they are able to hear that and then accordingly suggest you the right products. So it's not Amazon selling data to YouTube. It is the YouTube collecting data from your phone based on your search history, what you're doing on your phone, Namrata. So earlier we used to pay consideration in cash. Now we are paying consideration in kind, which is by giving the right to our personal data to all these companies. Are we getting that? So now we are paying the consideration in kind and not in cash by allowing these companies to collect our personal data and then monetize that data by selling that particular data. This is how these companies are not for free. Instagram is not at all free. You're paying consideration in kind to Instagram, which is allowing them to use your personal data. Are we clear? So in these situations, equalization levy will be applicable. Fine. Now the last thing is, what is the meaning of e-commerce supply or services? So e-commerce supply or services are again defined to mean online sale of goods, owned by the e-commerce operator, online provision of services, online provision of services provided by e-commerce operator, online sale of goods or provision of services facilitated by e-commerce operator. Online sale of goods or provision of services facilitated by e-commerce operator. Fine. So it is not necessarily only the sale of goods which are happening through me, but if I'm facilitating also, that will also get covered over here. Are we getting that? Yes or no? So let's say for example, there is a company. Let's say there is a company which is operating an electronic facility, which is let's say a website to sell the goods manufactured by it. To sell the goods manufactured by it. Then in that particular case, it is online sale of goods which is made by it. But let's say, for example, we talk about Amazon. So that is online provision of services, which are facilitated by it, or online sale of goods which are facilitated by it. It is not making its own sales, but it is facilitating the sales, or booking.com. Now, what is additionally covered here? So it says that online sale of goods and online provision of services will include acceptance of offer for sale, placing of just purchase orders. If any of the activity is online, if even one of the activity is online, it will be covered under online sale of goods. So you can just write it over here. Includes acceptance of offer for sale, placing of purchase order, even though the orders are delivered physically, but you're placing the order online, it is online sale. Acceptance of purchase order, payment of consideration, and supply of goods or provision of services. Fine? Yes or no? Now, once you have the equalization levy which is applicable, then you have the exemption under section 1050 of the Income Tax Act. So if the equalization levy is applicable, that particular service will not be chargeable to the Income Tax Act. So section 1050 of the Income Tax Act exempts the transaction which is subject to the equalization levy. Transaction which is subject to the equalization levy. So once you have the equalization levy applicable, then in that particular case, you will not be again subject to the Income Tax Act. Are we clear? Yes or no? Yes, students. So in order to avoid double taxation, it says any income arising from the specified services which are chargeable to equalization levy, transaction subject to the equalization levy. Fine. But under the equalization levy, once you come in, it says if the consideration for either the online sale of the ads or for the e-commerce supply of services, that will not include the services which are taxable either as royalty or the FTS. The services which are taxable as royalty or FTS under the Act read with the DTL. So section 1050 of the Income Tax Act exempts the transaction subject to EQL. But equalization levy 1.0 and 2.0 shall not apply on consideration chargeable to royalties or FTS under the Act read with DTL. So if a consideration is chargeable as royalties or FTS, then you will not apply equalization levy on that. But where you apply equalization levy, Income Tax Act will not apply. So basically, first you need to check whether the consideration is royalty or fees for technical service. If it is royalty or fees for technical service, then you don't come to equalization levy. Once you come to, let's say for example, it's not royalty or FTS, then only you come to equalization levy, and then the Income Tax Act will not apply in that situation. Clear? Also, one more important thing, this particular e-commerce supply of services here, the limit is 2 crores rupees. So this will apply. So equalization levy 2.0 will apply on the transaction which are over rupees 2 crores. Which are over rupees 2 crores. Are we getting that? Yes. So whether sales, turnover, or the gross receipts exceed rupees 2 crores. Sales, turnover, or gross receipts exceed rupees 2 crore. Fine? Yes or no, students? So equalization levy will not be charged, Namrata, on placing of order. It will be charged on the entire consideration. So consideration will include consideration for the sale of goods. It becomes applicable moment you place the order online. So the consideration that will be subject to equalization levy is the entire consideration of the sale of goods or provision of the services. Fine? Are we clear? Yes or no? Is equalization levy clear to you, students? Fine. Now, what is the time limit of making the payment? What are the return filing requirements for equalization levy? Let's understand that. So the equalization levy 1.0, as I said, 1.0 is collected by the payer. So it is just like a TDS. So every person who is a resident or a non-resident having a PE in India, which is making the payment for the specified services to another non-resident who does not have a PE in India, shall deduct the equalization levy at the rate of 6%. Are we clear? Now the time limit for the remittance of the equalization levy 1.0 is, so time limit to deposit is 7th of the following month. Just like your TDS payment, right? 7th of the following month. And in case you fail to deduct the equalization levy, so any assessee who fails to deduct the equalization levy, so failure to deduct the equalization levy, then in that particular case, he will be liable to pay the levy to the credit of the central government by 7th of the month immediately following the said calendar month. So any person who fails to deduct the equalization levy will have to pay from his own account. Will have to pay from his own account. Pay from own account to the central government. Secondly, what is the additional implication of this? If you fail to deduct the equalization levy or fail to pay the equalization levy, there will be the penalties and interest, which are common. So, interest which is there at the rate of 1% per month or the part of month. Then there will be penalty which will also be applicable, which is equal to the equalization levy, which is equal to the amount of the equalization levy. Fine. And if you fail to remit to the central government after deducting, then a penalty of 1,000 per day for failure to deposit. For failure to deposit. Are we clear? Additionally, you will also have disallowance of expenditure. You will have disallowance of the expenditure under section this we have already done it if you remember 40 IB. Under section 40 IB. Are we clear? So here the payer will be disallowed the expenditure if he has not deposited before the due date under 139(1). If not deducted or deposited before due date under section 139(1). Are we clear? So it will be allowed to the payer in the year in which he will deduct at deposit. Fine? Yes or no? So this is particularly the implication of the failure to deduct. Now, as far as equalization levy 2.0 is concerned, what are the time limits for depositing the tax which is there? So again here, the time limit for payment of the tax is, it is quarterly. Time limit for depositing Time limit for depositing equalization levy. Here the obligation is on the e-commerce operator and not on the payer, right? So it is quarterly. Again, just like your TDS only, the due dates remain the same. 30th July by 7th July. 30th June, sorry. Quarter ending 30th June by 7th July. Then 30th September by 7th October. 31st December by 7th January and 31st March by the 31st of March. Are we clear? So this is for the equalization levy 2.0. Additionally, every assessee who is deducting the equalization levy 1.0 or the e-commerce operator shall furnish a statement in form number 1 on or before the 30th of June. So the statement has to be furnished even for the equalization levy 1, where online sale of advertisement is there, or the e-commerce supplier services and the equalization levy 2, which is to be furnished after the end of the financial year with form number 1 on or before the 30th of June. So statement, this is a return to be furnished for equalization levy 1.0 and 2.0 by 30th June. Fine. And this can be revised before the expiry of 2 years from the end of the financial year. So this can be revised before the expiry of the 2 years from the end of the financial year. Yes. So basically this is the kind of the return for the equalization levy. This is the return for the equalization levy. Now, here also if you do not pay the equalization levy 2.0, so failure to pay, you will have interest at the rate of 1% per month or part of month, penalty equal to the equalization levy. Okay. So penalty equal to the equalization levy. And if you fail to remit the equalization levy to the central government, then it is 1,000 per day. Okay. Yes. Clear? And if you fail to furnish this statement, there will be penalty of rupees 100 per day. Penalty of rupees 100 per day. Yes or no? Any doubt, students? Any question? Any doubt? Yes or no? Are we clear with this particular point? With the equalization levy? Yes or no? Yes, students? Namrata, in case of Instagram, the constitution is kind. But what is the income of the Instagram? Income of the Instagram is in the form of the ad payments that it charges to the advertisers. So that is the income that shall be chargeable. Yes or no, students? Any doubt? Any questions with respect to equalization levy? Yes, Viraj, very good. Last one point which I will want to cover. So we will go back to the section 911 where we dealt with the SEP. Okay. There is one more amendment which has been made under the SEP, not under the SCP, under the business connection. And what is that? Since I wanted to cover that after the equalization levy is done, as explanation 3A has been inserted, which provides that the income attributable to the operations in India, income attributable to the operations carried out in India, so income from business connection. This is not for SCP. This is income from business connection would include the income from advertisement which targets a customer in India, advertisement targeting customer in India, customer who resides in India, customer who resides in India, or who accesses the ad through IP address in India. Sale of data, collected from person who is resident in India or who accesses the IP in India, and sale of goods or services using the data collected from a person resident in India or accessing through Indian IP. So basically, in case the business connection gets constituted, then the income which is attributable to that business connection activities will also include income from sale of advertisement, sale of data collected, or sale of goods or services using that data collected. So this is only when the business connection gets constituted, in which case the equalization levy will not be applicable, right? When business connection gets constituted. This is not for SCP, this is for the business connection. So when business connection gets constituted, the income which is attributable to the operations carried out in India would include the income from all of these particular activities as well. Fine. Also, last one important thing. Again, equalization levy 2.0 is not applicable to non-resident having PE in India. So if a non-resident has a PE, then of course you go to Income Tax Act, you will not come to equalization levy. Clear? We'll solve the question, Amrita. You will understand. Let me just open up some questions from your module. We'll solve that. Let's solve the questions from your module itself. And then it will be crystal clear. In case you still need that, we will again summarize it. Okay. So the first question, I'm putting it over here. ABC Limited, an Indian company, is carrying on the business of manufacture and sale of teakwood furniture under the brand name of Pure Wood. In order to expand its overseas sales or export, it launched a massive advertisement campaign of its product. For the purpose of online advertisement, it utilized its services of PQR Inc., a London-based company. During the previous year, ABC paid 5 lakh to PQR for such services. Discuss the tax implications or the TDS implications of the payment. If PQR has no P and if PQR has a P and the service is effectively connected to the P. Yes, students, tell me the answer. Yes, first, when PQR has no P, whether equalization levy will be applicable. Yes, students, faster, it's very simple. So equalization levy 1 is applicable when the non-resident e-commerce operator does not have a permanent establishment. Okay, does not have a permanent establishment, provides the specified service, which is online advertisement or sale of or online provision of the digital ad space to a person resident in India or another non-resident having a P in India. In that case, your equalization levy 1 will become applicable. Here it is a non-resident, which is London-based company providing services to a person resident in India. In the first case, it does not have a P. So yes, definitely the equalization levy 1 will be applicable. So here in this case, EQL 1.0 at the rate of 6% will be applicable. And since the payment is more than 1 lakh, equalization levy is applicable. If it has a P in India, then of course, equalization levy is not applicable. Section 1050, exemption of income tax, is also not applicable. Therefore, the TDS under section 195 will apply. So TDS under section 195 will be applicable. Are we clear? Yes, Namrata. Yes, Mansha. Yes, Viraj. Correct. Fine. When there is P of the non-resident in India, then equalization levy 1.0 will not be applicable. And in that case, you will have the normal TDS obligation. Okay. Let's solve the next question. Next one is MNO, a country A-based company, is carrying on the business of manufacture and sale of furniture under the brand name of Pure Wood. Now, in the earlier case, ABC was the Indian company. Here, it is a non-resident company. In order to increase its share in Indian market, it launched a massive advertisement campaign. For the purpose of online advertisement, it utilized the services of PQR Inc., a country Y-based company which also owns and operates a digital platform. Gross receipt from the provision of such service is 3 crores, meaning it is more than 2 crore. During the previous year, MNO paid 5 lakh to PQR for such services. Discuss the tax implications. Both MNO and PQR have no PE in India. First scenario, where both do not have any permanent establishment. Then equalization levy 1, equalization levy 2, what will be applicable? So where PQR is the service provider, it does not have a P, right? MNO is the service recipient. That also is a non-resident and that also does not have a PE. In that case, we cannot apply equalization levy 1.0 because the service recipient, if it is a non-resident, it should have a P for the applicability of equalization levy 1.0, right? So in that particular case, equalization levy 1.0 is not applicable. Namrata, I said that in the earlier example also, see, the service provider should not have a P. If the service provider has a P in the first example that we dealt, in the second situation, service provider had a P. So we will not apply equalization levy. If equalization levy is not applicable, meaning the consideration paid is not exempt from income tax. Because only when the equalization levy is applicable, you will be exempt from income tax. Now, if equalization levy is not applicable, section 1050 exemption will not apply and therefore you will be required to pay the TDS under 195. TDS under 195 is on the payment to the non-resident. Is that clear, Namrata? Yes. In this case, the service provider does not have a P. Service recipient also does not have a P. If a service recipient is a non-resident, it should have a P. So in that case, equalization levy 2 will be applicable. Now, if service provider does not have a P, but service recipient has a P, then in that case, we will go to equalization levy 1. And where equalization levy 1 is applicable, equalization levy 2 will not apply. Are we clear? Third case, they are saying if the PQR has a P, meaning service provider has a P, then in that case, equalization levy does not become applicable. Then you will have the income taxable under Income Tax Act. And in that case, what you will do is you will apply normal 195 TDS provisions and section 911 will become applicable. So this advertisement income would be deemed to accrue or arise in India. So section 911 income included if business connection is constituted. Okay. This can also result in SEP. This can also result in SEP, soliciting of business activities, right? Under SEP, we saw that more than 3 lakh user, that information is not given, but it can be transaction in respect of goods or services. Can result in SEP also. Fine? Yes or no? Any doubt, any question? Okay. Yes or no? Any doubt, any question, students? Yes? Yes, students, faster. Okay. Yes, Namrata, I'll just quickly recap. So equalization levy 1 on the online digital advertisement, online advertisement and online sale of space. Service provider, a non-resident who should not have a P. Equalization will never apply. Equalization levy will never apply when the non-resident service provider has a P in India. In that case, you go to section 911, business connection, SCP, you will check that. Equalization levy will not apply if a service provider non-resident has a P. Clear? Secondly, service recipient should be a person resident in India or a non-resident having a PE in India. And the transactions are more than rupees 1 lakh. The consideration is more than rupees 1 lakh. It excludes the personal services. Equalization levy 1 excludes the personal services. So this will be taxable at the rate of 6%. The payer has to deduct that 6%. Equalization levy 2, e-commerce operator has to pay 2% on consideration received from e-commerce supply or services. E-commerce supply or services will include online sale of goods, online provision of services, online sale of goods or services facilitated by the operator. Right? E-commerce operator can be anybody who owns, manages any digital facility. So e-commerce supply or services will include even if one of the activities online, which is purchase, placing purchase order, acceptance, making payment, whatever. The service should be provided to a person resident in India, a person who accesses the IP address located in India, or a non-resident in specified circumstance. What is a specified circumstance? Sale of ad, which is targeting the Indian users, Indian resident, or sale of data collected from the Indian resident or person who accesses Indian IP. Then in that case, e-commerce operator has to pay 2% equalization levy. The year, the limit for the sales turnover or gross receipts is more than 2 crores. Clear? Yes or no? Payer can be individual Namrata under equalization levy 1, but it should not be for personal use. It should not be for personal use. It should be for his business or profession. Clear? Yes or no, students? Yes, any questions, any doubt? Okay. So let's move towards the next important point over here. As I said, under the BEPS action plan, 3 things were recommended: equalization levy 1, equalization levy, the SEP, and the withholding taxes, which is TDS. So this I'm just giving a quick recap to you. TDS under section 194O. You have already done that in your TDS classes. So I'm not going to spend much time on that. TDS under 194O, which is applicable on the, again, e-commerce operator. But here there is a difference between the equalization levy and the TDS under 194O. What is the difference between the TDS under 194O and the equalization levy? In the TDS under 194O, the TDS is applicable on the e-commerce operator. Now, e-commerce operator can be anyone. It can be a non-resident or the resident e-commerce operator. But what is important over here is the e-commerce participant should be resident. So here, TDS under 194O is applicable on e-commerce operator, which is facilitating the sale of goods or provision of services of the e-commerce participant. This can be resident or non-resident. So sale of goods or provision of services through the e-commerce operator. This has to be the resident. Right? So this is facilitated by the e-commerce operator through its digital or electronic facility or platform, which is facilitated and which is provided to the ultimate buyer. So on the consideration which is paid by the e-commerce operator to the e-commerce participant, on this there will be TDS under section 194 at the rate of 1%. At the rate of 1% of the gross amount of sale or services. Okay, so it will deduct the income tax at the rate of 1% of the gross amount of such sale or services or both. Okay. So this will be on the gross consideration. So let's take an example to understand the distinction between the TDS under 194O and the equalization levy. Now here also one more important point. Here this will be applicable where the gross sale of services exceed rupees 5 lakh. Okay. So this will be applicable where this is more than rupees 5 lakh. Okay. Any doubt, any question? Fine. Okay, so just write down over here. Let's say, for example, I'll give you two examples. Let's say this is booking.com. This is a non-resident company, right? This is a non-resident company. Now, let's say I want to go to Europe. I want to go to Europe. I am searching for the hotels. So I booked the hotel in Europe, let's say, or let's say Hilton. What example we were seeing? Hilton, Germany. This is listed on booking.com. So I booked through the booking.com and booking.com will then pay the amount to Hilton, Germany. Let's say I book for $1,000 per day. Okay. And booking.com will charge, let's say $10 as commission for facilitating this transaction. And then it will pay rest $9.90 to Hilton, Germany. So on this particular transaction, one non-resident e-commerce operator providing the e-commerce supply or services to a person resident in India, equalization levy at the rate of 2% on $1,000. So this is a case of non-resident e-commerce operator providing services to resident in India. Providing e-commerce services, e-commerce supply of services to person resident in India. So equalization levy is applicable. Now let's say instead of Hilton, Germany, if this is Taj, Bombay. I am a customer resident in India. I am paying to booking.com, let's say rupees 2,000, and it is taking, let's say $10 as commission, or let's say hypothetically 100 as commission, and balance it is paying to Taj Bombay 1900. Then in that particular case, in this case, booking.com, though it is a non-resident, will deduct TDS under section 194O at the rate of 1% on 2000, because this will become e-commerce participant who is a resident. So if there's a resident e-commerce participant, TDS under 194O will be applicable. Yes, ads should be for specifically targeting Indian customers, Namrata. Are we clear? Are you understand the difference between equalization levy when it is applicable and TDS under 194O when it is applicable? Yes or no, students? Any question? Okay. Shall we start a new topic then? Yes, students, faster. Any questions? Any doubt? Okay. So let's move to the next topic then, which is virtual digital asset. Taxation of virtual digital asset. Yes, all of you, I'll request you, just I'm giving you 2 minutes to go through the entire thing that I've given. In case you have any doubt, you can ask me because it should be clear to you before we proceed to our next topic. Yes, fine. Is it clear? Okay, let's start with the next topic then. So, income from virtual digital asset. Now, what is virtual digital asset, students? Now, virtual digital asset is a term which is being used for these tokens, crypto money, which is there, cryptocurrency, which is there. It also includes the non-fungible tokens, which are there, NFTs, Bitcoins, all of that. So it's an umbrella term, virtual digital asset. Section 247A of the Income Tax Act defines the virtual digital asset. So definition is very technical, but it just means that it includes any information or code or any number or any token which is not Indian currency or a foreign currency, which is generated through the cryptographic means. Okay, which basically provides the digital representation of the value exchange, which kind of demonstrates you that this is the value which is you are exchanging. And this is dependent on some underlying asset, which has like basically what is the currency? What is the Indian currency? You have learned in economics also. What is a currency? It provides the promise or the representation of having some inherent value. It functions as a store of value or unit of account, right? It can be transferred or traded. So that is the currency, right? But this is generated through the cryptographic means. Again, with the promise of having some inherent value, which functions as a store of value or unit of account which you can use it for any financial transaction, which can be transferred, stored, or traded electronically, or any non-fungible token. So that is the virtual digital asset. Are we clear? So in these cases, we have a separate taxability which has now come up. Okay, which has now come up. So what are those? I'll first put out the definition for your reference over here so that you can just see the definition. So as I said, section 247A defines the virtual digital asset. And it means any information, code, number or token which is generated through the cryptographic means, right? Which is generated through the cryptographic means, providing a digital representation of value exchanged with the promise or representation of having some inherent value which functions as a store of value or unit of account and which can be transferred, stored or traded electronically, as well as a non-fungible token. So CBDT has clarified what is not included in the virtual digital asset. What are exclusions from that? So exclusions are gift cards or vouchers used to buy goods or services. So you get these gift cards, Myntra gift card, Amazon gift card. Those are not virtual digital assets because there were apprehensions that this may be classified as virtual digital assets. So they have just excluded it. Reward points. You get reward points or mileage points on flight tickets or on the credit card or loyalty cards. These are again not the virtual digital asset, which you can just redeem it when you are again booking or buying something. Subscription to websites or platforms or any applications. Again, this is not the virtual digital asset. Now, how the income from the virtual digital asset is to be taxed? It is to be taxed, the income therefrom, tax at the rate of 30% on gross basis under section 115 BBH. Meaning you will not be allowed no deduction of the expenditure is allowed. So no deduction of the expenditure would be allowed except for cost of acquisition. No set off or carry forward of losses are allowed. No set off or carry forward of loss from transfer of VDA is allowed. Okay. So this will be taxable whether it's business income or whether it is capital gain. This will be taxable under section 115 BBH. Plus, in the hands of the recipient, in the hands of the recipient, if it is received without consideration, or received for inadequate consideration, then you will have, and if the aggregate fair market value if the fair market value is greater than rupees 50,000, and here in this case the consideration paid, FMV minus consideration paid, is greater than rupees 50,000, then this would be taxable under section 56(2)(10). This shall be taxable under 56(2)(10). Okay. So This will be if it is received without consideration or received for inadequate consideration. If received without consideration, entire fair market value. If received for inadequate consideration, then the difference amount will be taxed under 56(2)(10). However, this will be not applicable on the gifts and exclusions which are applicable to 56(2)(10). Okay. So it will not be applicable in those situations. Namrata, not the promissory note. Promissory note is not, it's not generated through cryptographic mean. It should be generated through cryptographic mean. Mansha, it will be taxable under income from other sources if it is under 56(2)(10). Even in case of if you are doing business, it will be under PGBP. In case you are transferring the virtual digital asset, it will be under the head capital gain. In case it is received as other sources, then it will be under income from other sources. So the head view will classify according to the income that is getting generated, but the taxability shall be on. This is the tax rate that it is providing. It is not providing under which head it will be taxable. So characterization under different head will be subject to the rules of the different heads of income depending on what you are doing. But this is just the tax rate which is applicable for all the heads. So, just like that, you have certain income which are taxable at special rate, irrespective of head in which it gets classified. This is like that. This is going to be taxed at a special rate. Also, there will be TDS under section 194S. The TDS will be at the rate of 1%. The TDS will be at the rate of 1% at the time of credit or at the time of payment, whichever is earlier, the TDS has to be deducted. Okay, so the TDS is going to be deducted under 194S. And again, for that, they are saying that the TDS is not applicable. The TDS is not applicable in situations where the threshold limit is provided. So what is the threshold? The threshold is provided. So where the consideration is payable by individual or HUF, the threshold is 50,000. Okay, sorry. Yes, 50,000. Secondly, whose total sales, individual or HUF whose total sales, gross receipts or turnover exceed from the business or profession exceeds rupees 1 crore or rupees 50 lakh, 1 crore in case of business, and rupees 50 lakh for profession. Okay, during the preceding financial year. And for any individual or HUF not having business or profession, the turnover is 50,000 limit. Threshold is 50,000. Second is, sorry, this is for the individual or HUF. You can write like this. Give me a minute. and for the others, the threshold is 10,000. Okay, so these are the thresholds which are provided under section 194S. Now, in case where the consideration for the transfer of virtual digital asset, sometimes it may not be in bank, it may be in kind also. Sometimes it may not be only in cash, it may be in kind, because it is possible that one cryptocurrency is exchanged for another cryptocurrency. Then the person responsible for paying the consideration has to ensure that the tax has been deducted before the transfer of the virtual digital asset. Okay, before releasing the consideration, he has to ensure that the TDS has been deducted. So if consideration in kind, example, exchange of one BDA for another, then in that case, person responsible for TDS to ensure deposit of TDS before paying consideration. Okay. Are we clear? Any doubt? Now, what is the time limit? Again, here, the time limit for remittance to the government in case of the specified person, which is individual or HUF, and the other person, it is 30 days from the end of the month. So, in case of the specified person, it is 30 days from the end of the month. In case of exchanges or any other person, in that case, in case the TDS, it has to be within the 7 days from the end of the month. Okay. So then this is how you will deduct the deposit the TDS under 194S. In case of a specified person, it is 30 days, and in case of any other person or exchanges, in case of exchanges, it is going to be 7 days from the end of the month. Are we clear? Who is a specified person? Individual or HUF, who does not have any business income or who has a business income more than rupees 50 lakh, or in case of profession 1 crore in the case of business. So that is a specified person. Okay. So for time limit, you can just write down time limit for depositing TDS. It is going to be for individual or HUF 30th of next month, for others 7th of next month. For others, it is 7th of next month. Yes or no? And in the case of March, before 30th April. In case of March 30th April. Just like the normal TDS provision. Now, statement to be furnished. The statement to be furnished is, again, for individual, you can write like this only the year. Statement to be furnished is Form 26QE for the individuals within, again, 30 days from month of deduction. In case of any other person, it is 26Q. It is 26Q. And for exchange, this is 26QF. What is the time limit? This is quarterly. This is quarterly by 31st July for the June quarter, then 31st October for the September quarter, then 31st Jan for the December quarter, and finally 31st May for the March quarter. Okay. And then, of course, the TDS certificate has to be furnished in form 16E and 16A. Clear? Yes or no? Any questions? Any doubt? Yes, students? Yes? So income from the VDA, irrespective of any other income, would be taxable at the rate of 30%. Only thing you will get is the deduction of the cost of acquisition. You will not get any other deduction. Okay, you will not get any other deduction. And additionally, you will have the TDS under 194S. You will have the TDS under section 194S. So income from the VDA and minus the cost of acquisition, this is how you will calculate your income from VDA. Are we clear? Balance income will be taxable at normal rate, but the VDA income which is there, that will be applicable at the rate of 30%. Okay? Fine. Yes or no? Any questions? Any doubt? In case there are any set off of losses that cannot be set off against the income from the transfer of VDA. Okay, so cannot be set off against income from VDA. You cannot deduct any expenditure. You can only deduct the cost of acquisition. Fine? Yes or no? Yes, students. Any question? Any doubt? Okay. Here, additionally, the provisions which require the higher rate of DDS on non-filers of income tax return, that is not applicable in case of the individuals which are required to deduct TDS under 194S. So, you can write down higher TDS, which is 5%, right, which is there for non-filers. Not applicable for individual or HUF deductors. And in case where the TDS is deductible under 194O as well as 194S, then the TDS under 194S shall be applicable. Fine. Yes or no? Any questions? Any doubt? Okay. So students, last what is remaining is the circular for 194S, which is there. Now, what does circular do is, the circular basically, the CBDT has issued the circular to clarify certain things. Okay. So one of the thing which was asked, which is kind of, FAQ, which was raised to the CBDT was that in case the transaction is taking place through a exchange, there are different exchanges through which the VDAs are transferred, right? You can do it private also, but there are these exchanges, which is like Binance, WazirX, all of these are exchanges where you can buy and sell like the stock market transaction. Now, in the stock market transaction also, if you see, when you buy and sell these securities, is there anybody who is deducting the TDS? Answer is no. So here, who is required to deduct the TDS? Whether the exchange is required to deduct the TDS, whether the purchaser is required to deduct the TDS, or the broker is required to deduct, who is required to deduct? Because what happens in the case of exchange? The payment is made by the purchaser to the exchange either through his depository, like you have, securities account, which is there. In shares, you have HDFC Security, Kotak Security, Zerodha, in which you are holding the shares, right? So even under the cryptos, you will be holding the cryptos through a broker, or you may be holding it directly through your wallet. So your payment will go from your account, your bank account, to your broker's account, from broker to exchange, from exchange to the seller. So in that case, who is required to deduct the TDS? So in case of, let's say there is buyer, then there is broker, then there is exchange, and then there is finally the seller. So in these cases, the CBDT has clarified that where the transaction is happening from directly buyer to the seller, peer-to-peer transaction, the buyer is required to deduct the TDS. Are we clear? And then the buyer is required to furnish the statement in form 26Q. However, here, in case the transaction is taking place through an exchange, there are multiple stages which are involved. So in case where the transfer of virtual digital asset takes place through an exchange and the VDA being transferred is owned by the seller now. In this case, the buyer would be making the payment to the broker, broker to the exchange. Then the exchange would be required to credit the payment to the seller of the virtual digital asset. Again, there may be here another broker also. There is a possibility here. Seller broker is also involved. Right? So there are multiple layers. So in this case, the CBDT has clarified that the TDS may be only deducted by exchange. So TDS to be deducted by the exchange while making the payment to the seller. Are we clear? So in case where, let's say for example, seller broker is owning the virtual digital asset, it is the broker who is the seller. Hence, the amount paid by the exchange to the seller broker will be subject to the TDS. Are we clear? And in case, let's say for example, the broker is not the seller, but the seller is somebody else. In this case, the TDS is to be deducted by both the exchange as well as the broker. However, if both agree that only the broker may deduct the TDS, then in that case, the broker may only deduct it. So it depends on how the exchange and the broker agrees. Are we clear? So in case where there are multiple players which are involved, then in that case, the exchange is required to deduct TDS. Now, sometimes it is quite possible that sometimes the exchange may own the VDA. The exchange may own the VDA. In that case, there are no multiple players. So in that case, the buyer is required to deduct the TDS. However, how the buyer will know whether the asset is being owned by the exchange or by the final seller? Because buyer is buying the virtual digital asset from the exchange directly. So in that case, the liability is on the buyer to deduct the TDS or his broker. However, they may enter into an agreement with the exchange that the exchange shall deduct the TDS. That the exchange would be paying the tax on or before the due date. Are we clear? So in case VDA owned by exchange, buyer can deduct TDS. Alternatively, enter into agreement with exchange to pay the tax. Because in these are very private transactions. Nobody knows who is going to pay, right? So in these cases, there is no clarity that who is owning which asset. These are cryptocurrencies. It's very, very private, very secure transaction. Are we clear? So in this case, therefore, the CBDT has clarified. Now, what will happen if, let's say, there is exchange of VDA for another VDA? The situation may become more complicated. Are we getting that? So I may buy another cryptocurrency for selling one cryptocurrency. So let's say there is cryptocurrency A is being exchanged with another cryptocurrency B. So in that case, both buyer will become seller also, will become buyer also. I am selling one cryptocurrency, buying another. So then who will deduct the TDS? Because one is for, let's say, crypto, one is buyer for crypto A, another is buyer for crypto B. So then in that case, the CBDT says both need to pay tax with respect to the transfer of virtual digital asset and show the evidence to each other that the virtual digital asset can be exchanged. However, now what will happen if the transaction is through an exchange? Then in that case, the exchange is required to deduct the TDS in that particular case. So, in case VDA is exchanged for another VDA, both buyer and seller to deduct the TDS. However, if the transaction is through exchange, then exchange has to deduct. Because then you will not be able to know that who is buyer, who is seller. Are we clear? Then in that case, the exchange would be required to deduct TDS for both the leg of the transactions. Are we getting the kind of complexity that we are getting into? Now the tax which will be withheld by the exchange will be in kind. Now that in kind, so that will be in cryptos only. So you understand? The TDS which will be deducted by the exchange will be in cryptocurrency only. It will be in kind. What is in kind? Cryptocurrency. So that shall be converted into INR and deposited with the government. Are we clear? This TDS shall be in kind and to be converted to INR. Are we clear? Okay, yes or no? Now, whether the consideration which is paid will include GST. So it is clarified that the TDS is required to be withheld on the net consideration after excluding GST. So consideration will not include GST. For the TDS purpose, consideration will exclude the GST. Are we clear? And the last one is, in case where the payment is carried out through the payment gateway. Let's say, for example, if the person purchases the VDA through, let's say, Paytm. He makes the payment through Paytm. Now, in this case, the TDS has to be deducted by the person who is making the payment or by the Paytm. Or it is required to be deducted by both. So the CBDT has clarified. So if the tax is deducted by the person who is purchasing it, by the buyer, then TDS will not be required to be deducted by the Paytm. So purchase through digital payment. Example, this is buyer, this is Paytm, this is exchange, and this is seller. So TDS to be deducted by buyer. Once deducted, Paytm Need not deduct. Yes or no, students? So these are the clarifications which are issued by the CBDT. Namrata, as per the rate on that particular date, on the closing rate, they have to convert it. Okay. So this is very complex thing. You will have to revise it tonight, possibly, or tomorrow early morning. Please revise this so that you get the clarity on this topic. Okay. Any questions? Because next class that we have will be on assessment procedure. I know, Namrata, even I am hungry. I also didn't had my dinner, but I have to finish off this topic. Okay, yes, students. So thank you so much. See you in the next class, and I'm wishing you a very, very happy new year. Please revise it. Namrata, we are closing the session. I just wanted to finish off this topic, not to break the link. Thank you so much. If there are no questions, we can just close the session. Thank you, Mansha. Thank you, Namrata. A happy new year to all of you. Yes, session is over.